Are all those AI companies making all those AI deals about to fly off the proverbial hamster wheel, or does this artificial intelligence Capex boom still have room to run? Is Fed policy going to remain friendly to markets well into 2026, or could we be in store for a monetary policy surprise next year? And what about jobs? Amazon, UPS, JP Morgan Chase, they're all laying off thousands and thousands of workers or making do with less because they can thanks to AI. I brought an all-new guest on the Money Show MoneyMasters podcast to unspool it all and explain what these key market developments mean for investors like you. His name is Ed Clissold, and he is Chief US Strategist at Ned Davis Research. Ed, welcome to the podcast. Ed, thank you so much for joining me. I know there's a lot going on in the markets, and I want to get right to that in a minute. But since I haven't had you on the podcast before, can you talk a little bit about what your background is and what you do there at Ned Davis?
Sure. So I've been at NDR for 22 years. I was actually a client of NDR at a regional brokerage firm in Nashville, Tennessee called JC Bradford. For those of you who've been around a while, maybe you heard of it. That's also where Ned was before he founded NDR. So that was my connection to the company. And this was in the late 90s when the screens were green every day. And you had this guy saying, it's going on for a while, but this isn't how the world really works. Eventually, you're going to pay for it. So I came out of business school in '02. By that point, the bubble had burst and no one wanted to hire anybody. But there's Ned Davis Research because they were growing because they had the foresight, and Ned had the foresight. So I've been at NDR since then. I worked on the global team for a while, but for the last dozen years or so, I've been the US strategist focused on US asset allocation styles, S&P, sector calls, things of that nature.
Perfect. Well, appreciate the background. Kind of sets the stage a little bit there. I mean, as we're talking, S&P markets hitting new highs again after a little bit of turbulence in October. It's been quite the run. Where do you see markets as we get into here deeper into the fourth quarter?
As we get closer to the end of the year, the momentum trade seems to take hold. And I think it applies this year. Some years it doesn't, but particularly what we've noticed is that there still is a swath of investors who haven't completely gotten back in after the shock of the post-Liberation Day meltdown. I think most people got it back in to some extent, but maybe not fully invested, or there's certain hedge fund investors who maybe aren't levered as they had been previously. And so you're going to see some performance chasing. But it's beyond that. I say that the number one thing is that companies have blown estimates out of the water. Now, some of this is because the analyst community overshot on the downside. If you kind of nail it to one thing, it's that they overestimated the impact of tariffs on profit margins, kind of missing how much had been imported beforehand. Well, I think maybe the public was kind of taken aback, maybe perhaps by the shock. I think a lot of companies playing for it pretty well. But also, if you think about like the input costs for companies, or for some companies, what they're importing, their materials are important. But what's the biggest input for most companies? People. Yeah. So that's part of the reason why I think you've seen hiring slow down, is that companies are perhaps say, we're not going to hire as many people, or somebody leaves, we're just not going to replace them. And so you're not seeing, as many layoffs as if say you're going into recession, but you're seeing some of them. And so corporate America has just done a great job. And then you throw on the fact that the Fed is poised to, we're recording this on Tuesday. The Fed's going to announce tomorrow. Pretty high likelihood they're gonna cut again. So friendly Fed, subdued sentiment, good momentum, strong earnings, pretty good backdrop for stocks to do fairly well.
Yeah, let's talk about the labor issue first of all, because I mean, obviously the big news this week, Amazon, depending on what media report you look at, anywhere from 14 to 30,000, white collar type jobs. They're looking at maybe trimming. UPS blew out the numbers, but a big part of that was, as you mentioned, sort of cuts. 30 some odd thousand cuts that they've implemented as part of cost cutting. Do you think we ever get to a point where that's going to be an issue for Wall Street, or is that, more of a Main Street economic issue, and how serious of one going forward?
Yeah. So first of all, I think it gets to the K-shaped recovery of the economy, where the high-end consumer is doing really well. And that, is the big engine of growth for consumer spending in the US economy. But at some point, yeah, it could be too much for the economy to bear. But um, what I think there's a couple of things going on. In the case of I don't get into individual companies, but maybe for some of the huge tech companies that hired so much during and right after COVID, there
Yeah.
probably still is some sort of normalization of the labor force that needs to take place, but others are not. And what we've seen in particular is the labor force participation rate, which is kind of a mouthful economic term, but it's just who's working and who's looking for work, employed, unemployed. For young workers, 16 to 24 has dropped 2 percentage points year to date. Now that's a volatile group. They're more sensitive, so when the economy's slowing, they're going to feel the pinch first. But that's still a pretty big drop, and
Yeah.
you've seen that in particular in computer science, recent computer science grads. So these poor kids were told to program, and they slogged through 4 years of programming. Maybe they could have had a lot more fun if they're humanities majors and gotten a job, but they didn't. And so that now they're struggling. So I do think there's something afoot with the economy, where companies feel like they can cut some slack, and they expect to be employing AI tools going forward. And you've seen this in tech. Heard Jamie Dimon talk about that, where
Yeah.
they've gotten their AI tool to put together pitch decks that would take a team of junior investment bankers, days to put together. They can put together in a few minutes. I think that is coming. My view in the long run is that the economy will right size itself, and will find productive use of that labor. Meantime, it can be a little, it can be certainly concerning for the people going through it directly. In and of itself, probably not enough to cause a recession, but it's probably part of why the Fed needs to consider lowering rates at a time when inflation is still, sizably above its target. So put it in the something to be a little worried about category. Wouldn't put it in the time to panic zone. For example, we have our recession watch report. There's 10 different indicators in
Yeah.
that. We need 6 out of 10 to say you're high risk of recession. Right now, there's only one in the recession risk zone. That's ISM services. But unemployment claims, CEO confidence, consumer confidence, all well away from where you'd say, at least historically, well, the economy is probably going into recession.
Got it. So let's pivot to policy on the assumption the Fed will have cut 25 basis points by the time this airs. Moving forward, what are you looking for? One more meeting in 25, and then as we roll into 26, kind of, what is your general Fed outlook?
Yeah, pretty decent chance they'll cut again in December, and then probably another time in early 2026. So friendly for now, and we've studied it when you've had a Fed paused like we've had. So they cut, they pause for at least 6 months, and they resume cutting. That's what happened. They cut in December, waited 9 months, cut again in September. The market tends to rally, starting 3-4 months before the cut, which roughly would happen this time. Which I find is interesting. History doesn't repeat, it rhymes. And the fact that there's some consternation around inflation, albeit tariff induced, right about the time you normally get that during the Fed pauses, and then the rally happened again about the time you would get that. Going forward, the rally continues on average, although not quite as strong of a pace as it did the few months leading into those Fed cuts. My concern, though, Mike, as we head into next year
Yeah.
is what happens in May. We're going to get a new Fed chair. And sounds like they may announce the person early. Usually it's 2 or 3 months before in. They're talking about doing it before the end of the year. We'll see. I also think perhaps Trump, he's the master of suspense, whether you like him or not. He's excellent at this stuff. He may keep that drawn out for longer, but regardless, we're going to get a new Fed chair. This person is going to know the assignment, which is to keep lowering rates. But by May, if you get another 2 or more cuts, the Fed's going close to neutral.
Yeah.
And so it's going to be a pretty tough decision, I think, for the new Fed chair. Do you keep cutting on the expectation that inflation is going to come down, and those cuts will be justified? In which case, then the market may come into play. Do you start seeing inflation expectations rise? Do you start seeing the yield curve steepen more? Do you see credit spreads widen? These things that would suggest that maybe the Fed's making a policy mistake. Now, the new Fed chair could also come on and say, "Thank you, Mr. President. I appreciate the nomination, but now that I'm confirmed, my duty is to the economy. I have a dual mandate." And that person can then just live with the True Social post, just like Powell did. Probably not how it's going to go, but it's possible. There's a derivation of that where maybe the FOMC. Remember, this isn't just one person making the call. The FOMC could push back. You have to see how that would go. There's lots of ways, but the final thing is maybe everything does work out. Inflation goes down, Fed cuts, everybody's happy. I think that's probably unlikely. But the point is, right now we have some pretty friendly Fed policy.
Yeah. Hey, sometimes things do work out.
May not.
I'll keep our fingers crossed, right?
Yeah. And the way we do think the NDR is like, I don't try to get too concerned about what might happen in the future. I have all my indicators and data that's what I spend most of my day on. It's boring stuff, looking at indicators and stuff and trying to figure out, where they are right now. But a lot of people want to know what we think might happen. And I think that's on our radar. For concern for next year is one way or the other, Fed policy might not be so market friendly. And that comes right about the time the presidential cycle, in the middle of the midterm year, things tend to be rocky. And so it all could come into play.
You brought up the economy and markets and conditions at the end of the 1990s and early 2000s. So I have to ask the question, or at least bring it up, with AI, it's in the news every day. Is this a boom? Is it a bubble? Is it .com 2? Is it not? What are your thoughts on that and what it means for an investor? I mean, if you're involved in that sector, you've been investing and made a lot of money, what do you tell clients when they kind of come to you about the outlook there?
Yeah, so a couple of things. One is, look, the market is concentrated in a way it really never has been before. If you look at the top 10 stocks in the S&P 500, depending on the day, they're roughly 40% of the S&P 500. For perspective, in 2000, they were 10%. I'm sorry, they were 30%, 10 percentage points lower. Even in the early 70s, the Nifty 50 bubble era, they were 33%. So yes, we are beholden to these Mag 7 AI related companies, whether we want to be or not. If you're invested in a cap weighted index, that's where your money is allocated. Now, in terms of where we are valuation wise, so the second point is, if you were to say, look at a trailing price to earnings ratio, a forward price to earnings ratio, the S&P 500 is trading at near where it was in 2000. But also we were here in 2021. Now, we had a pretty nasty bear market in 2022. There wasn't a recession, but still 25% decline in the S&P. The point is, you could get a correction of this valuation predicament that we're in without a bubble popping. In fact, I'd argue that would be healthy. If you contrast it with 2015, we had a growth scare, a shallow bear market, because valuations were so much lower. That was less than 20% decline. Some people wouldn't even say it was a bear market. We classify it under NDR because it lasted, from May of 15 to February 16. That's long enough. But regardless, the decline was much less peak to trough because you started a lower valuation. Yeah. And so even a growth scare without a recession could lead to a bigger bear market. But I got to get to your real point, Mike, on the bubble. Um, right now, valuations are probably projecting a lot of gains from AI. We could get them, but eventually, we know that the not last capex dollar spent in a cycle is usually not one well spent at all. And in some ways, this is a classic capex environment. And the reason why these Mag 7 companies have been so wonderful is that they're generating all this cash flow and they return a bunch for the shareholders. And they still can return a lot to shareholders, but a lot more is being eaten up by the need to keep spending and growing faster and faster and faster, and they're all spending with each other. It kind of feels like a circular reference, and so eventually somebody's going to jump off the hamster wheel, and maybe everybody goes flying. In terms of, is this the end of the bubble or not? As somebody who lived through 1999, it doesn't quite feel that way. Now, again, this is
Yeah.
less about NDR indicators, more about the sentiment side of things. It really was a period where everybody piled in to just a few names. And this is something
Yeah.
I've been on my soapbox about this for a few years when people say, oh, the top, 5 stocks account for 60% of the gains of the S&P year to date. Well, that's how it works most years. It's cap weighted index. The biggest stocks that do well account for most of the gains. It's okay for the generals to lead if the infantry are following. And right now, the infantry are following. Most stocks are trending up. What happened in the late 90s is Eric really got into a few names. So
Yeah.
in April 98, we hit a shallow bear market peak. We had long-term capital management, Russian ruble crisis. The Fed cut rates a few times, and Greenspan famously got all the bankers in the room and said, well, you made this mess with long-term capital, you fix it. And then the market roared out of those October 98 lows, and the Fed then pumped extra liquidity into the system. For younger people, you may kind of laugh at this. There was real concern everybody's going to take money out of ATMs because of Y2K. And so the Fed put money supply in the system, and money didn't go to the ATM. People didn't take it. It went to the NASDAQ. The NASDAQ almost doubled.
Yeah.
But the average stock didn't. The advanced decline line, the running total of advancing stocks versus declining stocks, peaked in April 98. It
Yeah.
never got above that level through all the 99, L99 into early 2000. The value line geometric index, which is a kind of equal weighted composite, how the average stock is doing, likewise peaked in April 98. So we haven't seen that. We got a new high on the AD line just the other day. So is it possible to kind of bring the conversation about the Fed earlier? So is it possible that we get the Fed pumping too much into the system, money goes where it's treated best, and that creates an AI bubble from here? Possibly. My final note on the whole bubble discussion is these things can go on for longer than what anybody thinks. We all
Yeah.
know trees don't go to the sky. The economy will not be 90% AI investment. So eventually this is going to come to an end. But right now it doesn't feel like we're at the final throes of the bubble mania.
Got it. Let me ask you this as we come kind of the tail end of our conversation. What other sectors, you mentioned there is a lot more participation in this market. It's not all just tech. If you look at it from a sector breakdown, any other one or two opportunities that you think, from your standpoint, look particularly attractive here as we get closer to 26?
So on a sector basis, right now we're overweight tech, which obviously in the middle of that AI discussion. We also like utilities, which is somewhat AI adjacent. It's also a way to maybe get some defensiveness in your portfolio. We have an eye on some of the more cyclical value areas, like materials. With all this focus on reshoring and manufacturing, you would think that material stocks would participate in that. And recently they've been very volatile. But if they can establish new uptrends, we would do that. The other one we have on our radar, not pulling the trigger on this yet, but it could be getting close, is healthcare. It's recently fallen to its weight in the S&P is below 10% for the first time since the late 90s. And there's so much negative sentiment around healthcare. This is common after a new president is elected because they always campaign on ideas of shaking up the healthcare system. Certainly that's what's going on now. But on average, once you get 6 months or so after the new president takes office, a lot of that bad news is priced in. So again, we want to see the momentum turn, but it's a cheap sector, underloved, underowned, could be a place to look going forward.
Got it. Well, Ed, you're going to be joining us for the Money Show Masters Symposium in Sarasota here in December. Great to have you there. Glad you can make it. Just as a brief sneak peek, any things, themes, topics you think you're going to be touching on there for attendees?
So I've got a lot of questions on if small caps are going to be are finally ready to go, and so we'll probably talk a little bit about that and how growth stocks have continued to beat value stocks. And at NDR, we're really known for our investor sentiment work. We didn't touch on that a whole lot. I'd love to dive into the details about what's going on within sentiment, what part of the markets are showing frothiness and which ones are not.
Perfect. Well, viewers, if you are watching this, you're going to get a chance to get the latest insights from Ed on sentiment, on markets, and everything else at that event. It's the Money Show Masters Symposium Sarasota. We're set for December 1st to 3rd at the Ritz-Carlton Sarasota this time. If you've ever been to downtown Sarasota here, it's a beautiful location. Get a little bit of the best of everything while you're learning and have time for recreation, fine dining, and all that afterwards. Ed, thank you so much. Looking forward to seeing you there and catching up on markets.
Likewise, appreciate the time and looking forward to catching up in person.
Take care.